All right, look, you know that mortgage rates are very low. Should they be even lower? Maybe they should be. Matt Phillips is here to tell us why. Mr. Phillips.
Good morning.
I said this morning we wanted to make the show a little sexier today.
Right.
So we thought, let's get Phillips talk about mortgage rates.
Well, that's why I wore this sweater.
It looks nice on you too.
Yeah. So mortgage rates 3.87 is the national Freddie rate, average across the country, 30-year fixed.
Which is historically low.
It's lowest on record.
Right.
Going back to 1971, lowest on record.
However, could be lower. Could be lower.
They could be lower.
Could it be lower? It seems insane to say it could be lower. Well, you're saying it should be lower.
By most metrics, it should be. If you look at traditionally where the markup between the rate in the mortgage-backed securities market, this is the Fannie Freddie agencies that Dave was just telling about. Those are about 285, 290 right now. Traditionally, the mortgage rate that you see when you're shopping is about 50 basis points, which is a hundredths of a percent. So it would be 50. It would be, if it was 290, it should be about 340 right now. That's traditionally what the markup was. Now,
but it's not that.
Yeah, the markup is now double, basically.
And the question's why? I mean, is this just an issue of bankers taking advantage of a situation, pocketing some easy money?
I mean, it depends. It depends who you ask, right? I mean,
I wouldn't ask a banker that question.
Well, when you ask bankers, what they'll say is like, well, we're facing a lot more risk. We've written, we have to be very careful with our paperwork right now. Fannie and Freddie are being very strict about any little idiosyncratic error in any of the papers, and they're making us take these loans back if anything goes wrong. So they're saying that
as opposed to the Wild West days where you didn't need documentation.
Right. And that's what they're saying. It used to be very cheap to underwrite a loan. You didn't even have to make any money, have any pay. You know, you could just. So there's an element of that, but they're also saying they have to be more prudent. They have to take more risks. Particularly small brokers will say it's the big banks that really dominate this market. The top 5 mortgage originators do about 60% of the mortgage originations in the country, and the top bank, Wells, does about 30%. So
and that's up. It's up at least 15% from what it was 5 or 6 years ago, right?
Right. Well, the top 5 used to do about 45, you know, and that's when you had every Tom, Dick, and Harry with their own mortgage broker in your local strip mall. So there could be benefits to this system too. It could be structural.
So really quick, if mortgage rates should be lower, is there a sense that they will actually move lower?
Well, it depends. I mean, they could move lower and bring. There's 2 ways that spread could kind of come back down. I mean, you know, one way is mortgage rates could move lower, and that would bring it. The other rate is if the mortgage-backed security market sells off, and those rates go move higher. So there's a couple different ways. And mortgage rate in the mortgage-backed security market have been moving lower because people were expecting the Federal Reserve to maybe come in there with the economy looking a little bit better. Then maybe they won't be.
That's where we have to leave it. Any way you look at it, under 4% on a 30-year is very, very low.